My name is Jeff Sayer, and welcome to our 2017 Review 2018 Outlook webcast. I'm going to quickly review how 2017 played out in the markets and provide an outlook for 2018. This year, sector themes and positioning will be particularly important, so I'll try and provide a roadmap for 2018. Finally, I'll give an update on each of our mandates, and I'll run through the performance of the Sprott-focused Global Dividend Class, the Sprott-focused U.S. Dividend Class, the Sprott Global Infrastructure Fund, and the Sprott Global Real Estate Fund. 2017 was an excellent year for the U.S. markets. The S&P 500 total return was up 21.8% in U.S. dollars and 14% in Canadian dollar terms, but growth clearly disconnected from value. In the chart below, we see an S&P 500 growth ETF clearly outpacing the S&P 500 and the S&P 500 value ETF in the green line at the bottom. This was actually a relatively tough year for our funds, given our dividend focus, to outperform when the growth stocks led the market. But I think we did a reasonable job in 2017 generating absolute returns. In 2017, the market was driven by earnings growth, and estimates for the full year are coming in at almost 8.5% for companies reporting positive earnings, and earnings multiple expansion as tax reform in the U.S. became a reality. From the chart below, we can clearly see the multiple expansion from the middle of November through the year end as tax reform played out. 2017 was also an excellent year for the international markets. The S&P 700 total return was up 26.6% in US dollar terms and 18% in Canadian dollar terms. The S&P 700 is the international component of the S&P Global 1200 Index, so it excludes all United States-based companies. Performance was driven by Europe and the Asia-Pacific regions of the world and was certainly helped by a weakening US dollar throughout the year. For Canadian investors in our global or US mandates, the weakening of the US dollar or the strengthening of the Canadian dollar was a real headwind over the course of the year. We've heard several possible explanations for the US dollar weakness, including Trump policies will only create trade deficits and not economic growth. The US dollar acts as a funding currency when global growth accelerates, so foreign or emerging market companies look to borrow in US dollars, convert to local currencies, and invest in the businesses. Or foreign buyers are selling US treasuries and therefore the US dollar to buy Eurozone or emerging market bond and equities. For our 2018 outlook, let's first look at the macro environment. Currently, the JP Morgan Global Composite PMI is still in expansionary territory with about an index reading of 54. The U.S. yield curve remains flattish, which is the white line in the chart below, which indicates lower inflation expectations and low interest rates for longer. So despite the Fed hiking throughout the year and starting in December 2015, this is a benign environment for equities and income-oriented investments. And despite the Fed hikes, we've actually seen throughout 2017 the U.S. Treasury 10-year bond yield remaining relatively static. Some of the pushback we're getting on our positive outlook for 2018 includes valuations are currently at 10-year highs based on the forward PE ratio, which has expanded almost 20 times by the end of 2017. This indicates that future returns are contingent on solid earnings growth in 2018. We're also seeing that U.S. Treasury 10-year yields look to have broken out to 3-year highs. So in late 2017, early 2018, the U.S. Treasury 10-year bond yields moved to a 3-year high of 2.7%. This has spooked investors the last few trading days of January, although the yield curve has actually remained reasonably stable. We need to look back to early 2014 for the prior peak and the key level of about 3.0% on the U.S. Treasury. On a more positive note, global growth expectations in 2018 are accelerating. The IMF World Economic Outlook Update, released January 2018, indicates that the world output is expected to grow 3.9% in 2018 and 3.9% in 2019. The U.S. is expected to grow 2.7% in 2018 and 2.5% in 2019. The Eurozone area is expected to grow 2.2% in 2018 and 2.0% in 2019. The emerging markets and developing economies are expected to lead the growth, coming in at 4.9% in 2018 and 5.0% in 2019. All these data points are consistent with a global synchronized economic recovery. We're also seeing for 2018 that the S&P 500 earnings growth for companies reporting positive earnings or excluding companies that are reporting net operating losses is accepted to be exceptional at 24%. Now, admittedly, a large component of this growth rate is tied to U.S. tax reform, but a significant component is driven by revenue growth and margin expansion, leading to solid organic earnings growth in 2018. Looking at the 2018 sector themes, I wanted to look at sector position because in the mid to late cycle environment, this should be key to performance in 2018. And the performance through January should provide the roadmap for the full year. Leading the pace so far this year is consumer discretionary, but these results are skewed by the inclusion of Amazon and Netflix in the sector. The key mid to late cycle sectors are currently performing extremely well, with information technology, energy, financials, industrials, and materials leading the way. The typical rate-sensitive sectors are currently the weakest, with telecommunication services, real estate, and utilities suffering as the 10-year bond yield rises aggressively. Now, once we get through this January month-end period of volatility and weakness, I expect these sector trends to continue throughout the balance of the year. So I'll quickly go through a portfolio update for the mandates that we manage. The Sprott Focus Global Dividend class, you can see that we're underweight the defensive sectors, including consumer discretionary and staples. We're overweight the financials, industrials, and IT sectors, which is consistent with our mid to late cycle positioning. We're also very underweight the telecommunication services and utility sectors. We are underweight United States from a geographic perspective, and we're overweight Canada. In terms of performance, the Sprott Focus Global Dividend class was slightly below its benchmark and peers since inception, but has actually outperformed the benchmark and peers in 2017. And so given the fund's dividend focus, investors should generally be pleased with our performance since inception. Looking at the Sprott Focused U.S. Dividend class, again, you can see we are underweight the defensive sectors, the consumer discretionary and consumer staple sectors. Again, we are overweight the financials, industrials, and information technology sectors, again, which is consistent with the mid to late cycle positioning. We're also very underweight the rate sensitives, and we have zero exposure to real estate, telecommunication services, or utilities in the portfolio. In terms of performance in 2017, the Sprott Focused U.S. Dividend class was slightly below the benchmark and its peers since inception and in 2017. But given the exceptional run that the growth stocks had in 2017, again, our investors should be reasonably pleased with our absolute performance numbers. Looking at the Sprott Global Infrastructure Fund, you can see that we're underweight the three key components of our benchmark. We're underweight the energy sector, we're underweight the industrial sector, and we're far underweight the utility sector, given our total infrastructure approach. And this has freed up additional room to buy the consumer discretionary, the financial, the IT sectors, to create a differentiated approach to managing the infrastructure fund. We're slightly underweight the United States, and we're overweight Canada. In terms of performance, the Sprott Global Infrastructure Fund had a very good year relative to our peers and our benchmarks since we terminated the sub-advisory agreement and over the course of 2017. We're going to look to add later cycle names through 2018, including things such as engineering, construction, equipment, building materials, and perhaps even financials. Finally, looking at the Sprott Global Real Estate Fund, one of the key drivers of our performance over the course of the year was a very significant underweighting in retail, and specifically U.S. retail names, and a large overweighted position in specialized REITs, which included the wireless cell phone towers and data centers. We also took advantage of several periods of political risk in Europe to buy beaten down European equities. We are underweight the United States, and we are overweight Canada in the Global Real Estate Fund. Looking at performance, we can see that we've had excellent performance relative to our peers and our benchmark in 2017 and since the sub-advisor agreement was terminated. Our differentiated total real estate approach is working. Again, we will look to add later cycle names in real estate and real estate related equities throughout the year in 2018. So that's our 2017 review and 2018 outlook. I hope you enjoyed our webcast. I'm looking forward to another good year in 2018, and thank you for your continued support.